With many institutions now filing for ETFs, including that of BlackRock, the community that are in crypto at the moment are feeling a little bit more bullish than maybe they should. In this video, I'm going to kind of go down the bearish route for Bitcoin, the direction that it may take in the very near future. As I get into this video, if you find it useful and informative, smash that like button. I really do appreciate that. If you are new to the channel, then why not go ahead and subscribe, tap the bell, select all the notifications, and in doing so, you will be kept up to date with everything that we do here at Cheeky Crypto. Now, if you haven't yet joined us in Discord, what are you waiting for? Check it out. Link is in the description down below. It's a fantastic community talking crypto 24/7. It's completely free, and I don't think you'll be disappointed by what you find down there. So let's jump right down into the video, right? What's going on? What am I talking about? Well, here we have Bitcoin paired up with USDT on the weekly chart. Binance is our data source, and this isn't really kind of, the chart that's going to help depict this out, but there are some interesting things that are going on here that's probably worth noting anyway, so it's a good place to start. So here on this weekly time frame, there are a few warning signs starting to show. The first one is that we have a rising stochastic RSI. Now, the stochastic RSI, unlike the regular relative strength index indicator, is actually a lot more sensitive to price movement. It shows you when things are in an overbought or oversold situation much faster than that of the RSI. Now, we are moving up into an overbought range. We're not there yet. It still shows progression to the upside. So on the short term, we might actually see a bit of a push towards that $34,000, $35,000 level. However, at the kind of the macro level here, we should be a little bit concerned that we are reaching the overbought range probably within the next kind of month or so, because our monthly stochastic RSI is already in that overbought range as well. Okay, so over the next few months, we might start to see some cracks starting to appear with a big move to the downside due. And this is just going to be about correcting that stochastic RSI from an overbought to an oversold range. And obviously we can start to see greed seeping into the space as well. So interesting. The second thing that's on here that's worth kind of noting is going to be that we have our Gaussian channel. Now, our Gaussian channel historically has been very, very good at indicating bullish and bearish markets. However, as I've said many times in the past, I do think that something has changed. That is the foundation that builds upon these moving averages that are the Gaussian channel. Now, essentially, in the previous two cycles, we were staying above the Fibonacci extension level of 1.236 in that bear market retracement. However, this particular bear market back in 2022, we actually slipped down lower than the 1.382. We actually landed between the 1.382 and the 1.618. This is a fundamental change at the base level for retracement. So we cannot expect the same results that we saw in the previous two cycles when we have a very, very, very different base level. If anything, we are now representing what an Elliott wave theory structure would be, more of a WX, YX, Z, or even potentially deeper than that, and just a large WX and Y. There's a few concerns that we have to have here because we have come down deeper than the 1.236. So again, nothing is as clear as just history repeating itself. And if history is to repeat itself anywhere, I think it's actually going to be more aligned to the psychology of who is buying and who is selling, rather than a couple of candlesticks on a chart. And the next thing I kind of want to say is we kind of have mirrored very similarly to what was going on back here in 2019. However, the volumes behind the movements are very, very significantly different. For example, we're approximately operating on 40% reduction of movement of Bitcoin between exchanges and wallets, right? So for example, back here in 2019, we saw a very significant surge to the upside, right? There's approximately 6 million Bitcoin moving to and from the exchanges during that time, versus the 4 million that we currently find ourselves with here. So we know that volumes are down low, even though we've got kind of significantly more, or a very similar kind of setup in terms of candlestick, we know that we went down deeper than the 1.382. We know that we have about a 40% reduction approximately in the volume going to and from the exchanges. We also have different participants. So during this 2019 run, there was a lot of larger wallets, such as 1,000 Bitcoin or more per wallet. They were increasing during this move to the downside over here. Okay, they were buying that dip, essentially, right? Big money was buying and small money was selling. Over this side, however, you've got on the way down, large money coming out, so basically a reduction of around 7% in wallets that have over 1,000 BTC, yet we see smaller wallets actually increasing at the sum of about 16%. So we know that basically small money is coming in, and big money is leaving, vastly different to that of what was going on previously. So to expect the same result that we saw back in 2019, now in 2023 would, I think in my mind, just be the very definition of insanity. We know that there's very fundamental and foundational changes that have occurred on BTC at those levels. So, those are interesting, right? So we have a few different things here that we need to kind of consider, but that's not really what I wanted to talk about today, because we do actually see all of those things. We talk about them quite frequently on the channel, and they are very, very meaningful. But the next one is actually even more impactful. Okay, and that it comes down to the Fed and their interest rates. Okay, so obviously, whilst the interest rates have been rising, we've seen some volatility within the market, mainly driven from the DXY, which is basically the dollar index, and forex traders that are basically either coming out of the dollar into foreign currencies, such as maybe GBP, euros, Japanese yen, whatever it may be, right? And as such, you'll see the value of the dollar and the dollar index decrease. And that's actually meant that you need more dollars to buy your cryptocurrencies. Okay, so as those kind of the forex traders are coming in and out of the dollar, again, and basically trading as you would, it's actually having an adverse effect on BTC and the crypto market as well. So the DXY is quite an important metric. We can't just ignore that one either. So to start with, back in early 2023, we saw the dollar index drop quite significantly, which basically meant that you need more dollars to buy BTC than you did previously, okay, because the dollar index had decreased. And of course, you saw other currencies increasing slightly. So it's an interesting kind of way of analyzing the market as well, outside of just Bitcoin's candlesticks. That nonetheless, and that surge to the upside did of course cause a bit of a spur to the upside, and obviously created a bit of FOMO for retail investors, and retail investors continued to kind of come on in. That actually added some exit liquidity for those larger players who continued to exit the space during that time. So we find ourselves up just above the Gaussian channel, and an interesting point, the Fed have now paused their interest rates. But what would happen when the Fed pivot? And this is the thing that not many people seem to want to talk about. Well, this is what happens when the Fed pivot. So when the Fed pivot, we're going to see a significant crash to the downside. Let's just review a little bit in history here. So every time that the Fed has pivoted over the last let's just say a few decades, we have seen very significant moves to the downside. Most recently, we saw a 35% reduction back in 2019 when the Fed pivoted. We can also see that there's a Fed pivot over here. This one, early 2000s, I think, was 58% to the downside. Before that, 51% to the downside, 27% back in 1981. We have 48% in that Fed pivot over here in the 70s, and 36%. So when the Fed pivot, what's the expectation? Is the expectation that we're going to the moon and that we're in a bullish market, or is the expectation that we're going to have an almighty crash? And what degree of crash are we likely to have? We'll probably be in the 30 or so percent, maybe even deeper, depending on how this thing wants to play out. Now, essentially, there is some lagging or some lag between when the Fed pivot and the almighty crash to the downside. It's not instantaneous. In the three of these examples, we can see that the Fed pivoted. We actually saw a small move to the upside before we actually had that final crash to the downside. So there's a few interesting things we have to kind of take into consideration within this range. So we want to be aware that yes, a move to the downside is inevitable. We do see this on our weekly time frame from many different reasons, everything from the stochastic RSI all the way through to the fact that we have interesting Fibonacci retracement extensions that have been achieved, through to decrease in volumes and to tracking participants, who is buying, who is selling, and the fact that really it's only retail investors that are currently holding. And I think we're going to see some really rocky road ahead. And as kind of inflation has kind of soared on, not many retail investors have felt this pain just yet. It's kind of slowly working its way out there. There's a few interesting things that have happened to myself personally, everything from the mortgage doubling through to my car insurance almost doubling as well. It's actually an extra 33% on my car insurance. We have 3 times more I'm paying for energy, so your gas, your electric and things like that, all the way through to, as I said, the mortgage rate doubling. And so mortgage payments have doubled. Now, these things are, at least in the UK, something that kind of can be avoided for a short period of time, such as having a fixed term mortgage. And when your fixed term mortgage comes to an end, you're going to be subject to a new interest rate. And car insurance obviously is an annual renewal. So after that, time has kind of elapsed, you're going to be getting your renewal notices through, and there'll be increases there. Energy costs, again, sometimes they can be fixed in, and sometimes, again, they're going to kind of rear their head and basically charge you a lot extra as well. Of course, then we have the kind of essentials, the food that you're putting on the table for the kids, again, has increased dramatically. That has almost tripled for my family as well. So I think it's very important that we understand that some of the things that are going on with the interest rate hikes and the idea of basically sucking out liquidity from the market, because that's essentially what a rate hike does. It basically makes everything more expensive and it removes liquidity from the market, prevents people from spending. Yet at the moment, we haven't really seen the retail investors feel that pain, but I do think it is about to occur. And the reason for this is I think they've been buying Bitcoin, they've been buying their cryptocurrency assets, and they haven't really had the squeeze just yet. Maybe their fixed terms haven't yet come to an end. Maybe their renewals haven't come to an end just yet, but I do think that that's coming, and I do think it's going to hit retail investors incredibly hard. We already see, at least in the UK, a bit of a surge when it comes to housing, specifically on the lower side of spectrum, as people are trying to downsize. We see an abundance of larger houses up for sale, which are not moving, and yet we see fewer and fewer smaller houses actually up for sale, and they go incredibly quick when they do enter the market. This is essentially a sign that people are trying to downsize as quickly as they can to protect themselves. There's a lot of things to come here. I do think there's going to be a housing crisis that's going to unfold. I do think that Bitcoin is likely to have a very significant surge to the downside in a very similar way that we saw to 2019, and I wouldn't be surprised if many retail investors end up having to sell their cryptocurrency assets to basically pay the mortgage and keep food on the table. But let me know what your thoughts are in the comments down below. This is one potential scenario that could be playing out over the next few months for Bitcoin and for the crypto industry. Let me know what you think in the comments below. If you found this useful and informative, smash that like button. I do appreciate that. If you are new to the channel, then why not go ahead and subscribe, tap the bell, select all the notifications, and in doing so, you will be kept up to date with everything that we do here at Cheeky Crypto. With all that said, done out of the way, guys, I hope everyone has a fantastic day, and I'll catch you all in the next one.
We are not financial advisors, and none of what we have communicated verbally or in writing here should be considered as financial advice. It is not. Do your own research before investing in any digital asset or affiliate offers, and understand that investing in any crypto is risky. If you do, you need to be prepared to lose your entire investment. This video is for information and entertainment purposes only. All our videos are strictly personal opinions. Please make sure you do your own research and never take our opinions for financial guidance. There are multiple strategies, and not all strategies fit all people. Our videos are not